Hello everyone, welcome to JIB CIB Prep. In today's video, we'll discuss about unit number 26, different modes of charging securities. And in this particular unit, we'll understand about a contract. So what is a contract? How is it formed? What are different types of contracts? For example, what is a valid contract? What is a voidable contract? What is an agreement? What is a void agreement? And we'll move on to contract of agency, contract of bailment, and then we'll study about different types of charges. So assignment, lien, set off, hypothecation, pledge, mortgage, and right of appropriation. In between, we'll also discuss about lease. And finally, we'll understand what is a charge, what is a floating charge, what is a fixed charge, how do we register a charge. We'll do our practice question and wind up this class. So we all know that bank faces a major challenge when they lend money. So credit risk is always there. And to reduce this risk, keep that in mind, we cannot eliminate this risk. This risk will always be there because of the nature of the business in which bank is involved. So what we can do is to reduce this risk, and to reduce this risk we uses securities. So bank basically safeguard their advances by taking securities. So security is essentially any asset or property that the borrower offers the bank, so that if the borrower defaults, the bank can recover its money by selling or enforcing rights over that asset. So different types of securities are there: movable property, immovable property. Then there are debts, financial claims like book debt, insurance policy, bonds. So we have understand about different types of securities. We have already covered them. So the way in which a bank creates a charge, it depends upon the type of security. What is the type of security? For example, for land and building, we create a mortgage. Uh, for a vehicle loan, we create a charge of hypothecation. For loan against gold ornaments, we create a charge of pledge, so on and so forth. So it actually depends on the type of security. And there are some key laws involved in it: Indian Contract Act, Transfer of Property Act. So Indian Contract Act basically tells about the pledge, what is a contract of bailment, what is a contract of agency. Then Transfer of Property Act, mortgage is defined under Transfer of Property Act. So let me write it more clearly for you. Companies Act. So Companies Act require companies to register charges created on their asset. Registration Act is there, which deals with registration of documents like mortgage, lease, and SARFAESI Act is there. So hypothecation, the charge of hypothecation has been defined in the SARFAESI Act. So it basically empowers the bank to enforce security interest without even going to the court. So now let's understand what is a contract. So contract has been defined under Section 2H of the Indian Contract Act 1872. Since lending always involves agreement between bank and borrower, concept of contract is central to the banking. And according to Section 2H, any agreement which is enforceable by law is a contract. So this implies two things: that there must be an agreement between two parties, and that agreement, there should be an agreement, and that agreement should be legally enforceable. Thus, contract equals to agreement plus enforceability of law. And not all agreements are contract, keep that in mind. For example, if two friends agree to go out for a dinner, it is an agreement but not a contract, because it is not legally enforceable. Again, if a person wants to engage another person into some kind of illegal activities, so it is an agreement, but it is not a contract. They cannot move to the court for its enforceability, because it is not legally enforceable by law. And contract is divided into two parts. So there are two parts in which Indian Contract Act is are divided. So there are general principles of contract, and then there are special contracts like contract of indemnity, contract of guarantee, contract of bailment, contract of pledge, contract of agency. So it is divided into two parts. First is general principles and second is special contracts. Now let's understand about the essentials, about the key components of the contract. So we we are done with this. Let's understand these portions. So it is an agreement enforceable by law, which we have understood. Now, in order to say an agreement is a contract, free consent should be there, meaning to say the consent should be not obtained by means of coercion or fraud or misrepresentation or by mistake. So there should be a meeting of mind between the parties, that they are speaking about the same thing in the same sense, and then this consent should not be obtained by means of force, coercion, by fraud, misrepresentation, mistake, or undue influence. Then the consideration for this contract should be lawful, and the object should be lawful. The consideration should not be something illegal or morally wrong, right? So then for the object also it should be lawful, and it should not be expressly void. It should not be expressly banned by the law. So if law prohibits something, you cannot do it, right? So it should not be expressly void. Key components: proposal or offer. So when one person expresses willingness to do or not to do something to get the consent of another, it is known as the proposal. For example, a bank offering a loan scheme. So you can take it, the loan, or you can just refuse it. So when a bank offers, showcases a loan, so bank offers a loan scheme, it is a proposal, and when the other party accepts the proposal, it becomes acceptance. So a proposal is when one person expresses willingness to do or not to do something, it to get the consent of another. It is a proposal, and when another party agrees to the proposal, it becomes acceptance. So a proposal becomes a promise. Basically, proposal plus acceptance becomes a promise. For example, there are two individuals, A and B. Now, this particular person A offers his car to B for a sum of rupees, say 5 lakh rupees. Now, what is A doing? A is making an offer to B. Now, B can either accept the offer or reject the offer. If B accept the offer that, okay, Mr. A, I'll purchase your car for this particular sum of rupees, this 5 lakh rupees. So this is an acceptance. He has assent to the other party. He agrees to the proposal. So now this becomes a promise. A proposal that has been accepted becomes a promise. So the person who is making the proposal is known as promisor. So A is the promisor here, and one who accepts the proposal is the promisee. So B is the promisee. Now, what are the essentials of valid contract? Let's dive into it. First of all, in order to create a contract, there must be a proposal. There must be an offer. That offer should be followed by an acceptance. Once it is accepted, it becomes a promise. This promise should uh, be bundled up with consideration. If the promise and considerations are lawful, it becomes an agreement. So, agreement is nothing but a promise or set of promises along with a consideration. So when it becomes agreement, it should be legally enforceable, and then it becomes a contract. So the first step is offer, right? So there must be lawful offer by one party and acceptance by the other party. For example, a borrower applies for a home loan. So what the person is doing? The person is uh, offering to take the loan. So that is a proposal, and when bank approves it, it is an acceptance. So this offer is a valid offer. This is a lawful offer. So borrower applies for a home loan. When there is a catalog, keep that in mind. When there is a catalog or there is a tender, it is not an offer. It is an invitation to offer. So what bank does is, when it advertises its loan schemes, it is you who will make an offer to the bank that I want to get the loan, and when the bank approves it, the bank is basically accepting your offer, and then it becomes a promise and followed by a contract. So there must be a lawful offer by one party and acceptance by other. You should not uh, mistake offer with an invitation to offer. Invitation to offer is, for example, when there is an auction and you are bidding for something. Now, what you are doing is an offer. You are offering things that I want to purchase this particular piece of art or a particular item for this particular amount. So I am making an offer, and the auctioneer will accept your offer. So when he invites you, he is inviting you to offer. So that is an invitation to offer. An agreement can be oral or written. So however, for certain matters like sale, mortgage, or lease, it must be in writing, registered, and attested. If the formalities are not covered, then the agreement cannot be enforced in law. Consideration is something in return. This is something in return. So each party must get something of the value. So when the bank gives you the money in the form of loan, so the borrower agrees to repay it with interest. So bank giving loan is consideration for you, and you repaying it along with interest is consideration for bank. And without consideration, an agreement is void. Of course, there are exceptions, and we'll discuss it. But as a general rule, an agreement without consideration is void. Now, there are certain exceptions to it, that an agreement made out of natural love and affection between parties standing in near relation to each other, and if it is in writing and registered, then this agreement will be valid. For example, a father promising his son that if you score say 90% of your marks in graduation, or if you clear your JIB exam, I'll gift you a bike, or I'll gift you a car. So if the offer is made orally, then this is not a valid offer. But if the father made it in writing and gets it registered, then this agreement, even though son is not giving something in return, then this agreement also is a valid agreement, even though it lacks consideration from the part of the son. All right, so an agreement made out of natural love and affection between the parties standing in relation to each other, which is in writing and registered, it is a valid offer. And a promise to compensate to a person who has already done something voluntarily for the promisor in the past, and that is also enforceable by law. For example, a person has already played his part in the past, and for that portion, the promisee is doing something in return. So, a promise to compensate a person who has already done something voluntarily for the promisor in the past, or done something voluntary that the promisor was legally bound to do, is enforceable by law. And so in this particular scenario also, the consideration will not be required. So, for example, there is a person A and there is a person B. Now, A has done something in the past for B, some work he has done, all right, and afterwards, B promises A uh, that he'll give him some money or he'll do something for him. Now, although in this promise, there is no consideration from the part of A, but he has already done something in the past, voluntary for the promiser, or done something voluntary that the promiser was legally bound to do so, then this is also enforceable by law. Free consent should be there. We have already discussed free consent. Consent which is f- free from coercion, undue influence, fraud, mistake, or misrepresentation. If it is free from all of them, then the consent is said to be free. Consent is basically meeting of minds. For example, if I'm talking about a black car and if I'm talking about a say Baleno and you are thinking of a black car, say you are thinking of a Audi, then we are not on the same page. There is no meeting of mind. For example, if person A offers person B that I want to sell my black car for say 2 lakh rupees. Now A is talking about his Baleno and B is thinking that A also has an Audi, black Audi, and he want to sell his black Audi to me for 2 lakh rupees. So here there is no meeting of mind, hence there is no consent. And when there is a meeting of mind, then this should be free from coercion, undue influence, fraud, misrepresentation, and mistake. Capacity to contract. So, the parties must be competent to contract, meaning to say the party should be of the age of majority, they should be of sound mind, and they should not be legally disqualified. When we say age of majority, they should be 18 years and above. Sound mind meaning to say that the person is able to form a rational decision whether this particular agreement will benefit him or not. And when we say legally disqualified, so that person should not be legally barred by the law to enter into a contract. Say he should not be undischarged, insolvent, or bankrupt, so he should not be legally disqualified. Minus contract are void ab initio, meaning to say they are void from the very beginning and a minor cannot enter into a contract. There is a famous case of Mohiri BB versus Damodar Das Ghosh. So it is an old case around 1900s, early 1900. So minor mortgaged property to borrow money and then he refused to return the money. So the court held that the contract between the minor and the other party is void and they cannot compel the minor to repay and then also uh, they cannot take the mortgage property into their arms, so they have to return the property as well as they cannot compel the minor to repay because a minor contract is a void contract. Exception is there. If the contract is for necessities, then minus estate can be charged for it, but again minor cannot be asked to repay. There are three types of agreement: a void agreement, voidable, and void contract. So void contract is a contract that is valid initially but becomes unforceable due to some event. Say there is a change in law, so a valid contract becomes a void contract. So valid becomes invalid, it is a void contract. Void agreement is they are not enforceable at all. Minus contract is a void agreement. A contract without consideration is a void agreement. And voidable contract is a contract which is enforceable at the option of one party, but not at the option of another party. So if a contract is made using undue influence or coercion, so they are voidable contracts, except for mistake. If it is made by misrepresentation, fraud, undue influence, coercion, then the contract is a voidable contract. Contract Act and banking. So contracts are backbone of all banking transactions. Banking function are nearly impossible without enforcing agreements. Some key relationships are depositor and bank. So when a customer deposit money, the bank becomes a debtor and the depositor is a creditor. So we have discussed all of this in our unit 1. So all of these contracts are made possible. All of these things are made possible because of the Contract Act. So there's a contract between bank and the customer. So Indian Contract Act, this becomes very important. The contract of agency defined under Section 182 of the Indian Contract Act. Agent is a person who is appointed to do something on behalf of another or represent another in dealing with third parties. And a principal is the person for whom such work is done or who is represented by the agent. So in simple words, an agent is like a representative. He acts on behalf of principal and creates legal obligations between principals and the third party. With respect to authority, the authority of the agent means the power he has to act on behalf of principal. This can be divided into two parts: express authority and implied authority. Express authority is the authority which is clearly given in words, which are spoken or written. So a person writes to his lawyer to sell his property. The lawyer now has express authority. Implied authority is not directly given but can be inferred from the circumstances. So a shop manager has implied authority to buy goods for running the shop. So that is implied authority. It is inferred from circumstances and it is given in clear words. Meaning of agency. So test of agency is one such measure. Meaning to say agent binds a principal by his authorized acts. So if he does something and the principal is bound by that act, then there is agency. Agent creates a contractual relation on behalf of principal. So for example, a person appoints another person as his agent. So A is the principal, B is the agent, and B does some act, B does some agreement with C. So here contractual relationship between A and C is also created. Relationship between agent and principal itself forms a contract. So there are three uh, relationships between which are created in a contract of agency. So it is first between A and B, second between B and C, and third between A and C. So principal and third party, agent and third party, principal and agent. And also there is no consideration required to create an agency. This is an important pointer which you need to remember, that consideration is not required in order to create a contract of agency. Authority of agent. So we have discussed about express and implied. Extent of authority. So an agent has authority to do everything that is necessary and lawful for completing the assigned task. In emergencies, the agent can take all necessary actions to protect the principal from loss, just as a reasonable person would do for himself. So, a shipping agent during a storm sells some goods from the principal's shipment to prevent a bigger loss. It is acceptable. Uh, Generally, an agent cannot pass on his authority, so there is no delegation. But a sub agent can be appointed if the business requires it or if trade customs permits. The main agent is responsible to the principal for the acts of the sub agent. Keep that in mind. And if the agent acts beyond his power without the principal's knowledge, the principal can rectify the act, then it will become valid, or the principal can disown it. Simply, principal can disown it, and the agent is personally liable for that particular act. Del credi agent. So del credit agent is a special type of agent. He not only sells good on behalf of the principal, but also guarantees payment from the buyer. So for this extra risk, he gets an extra commission. So this commission is known as del credit commission. So if buyer fails, this agent will pay. In simple words, taking he's not only acting as an agent but also a guarantor for the credit which is extended to the buyer. And if the buyer defaults, this person, this del credit agent becomes responsible, and that's why he's charging an extra remuneration. Termination of agency. So agency relationship does not last forever. It can end in ways like when the principal revokes the authority, or the agent himself renounces the work, the purpose of the agency is completed, or either the principal or agent dies or become of unsound mind, or the principal is declared insolvent. So in all these cases, uh, the agency of the relationship of the agency becomes terminated. Duties of an agent. So an agent must act in the best interest of the principal, and his main duties include to follow the directions and the custom. So he must follow the instruction of the principal. If there are no instruction, he should follow the usual business custom. If he acts otherwise and a loss has incurred, then he must compensate the principal. He must keep proper accounts. So he should maintain proper accounts and show them whenever the principal demands. And he should not secretly deal for his own benefit. There should be no deal on own account. And if he does, the principal can cancel that transaction. Agent's remuneration. So normally an agent is paid after completing his work. However, he can keep money received on sales towards his commission even if all goods are not sold. If the agent misbehaves or acts dishonestly, he loses his right to remuneration, and the agent has a right to keep principal's goods or papers or property until the principal clear of all the agent's due. So, an agent has a right to lien. What is the legal position of principal for agents act? So, for lawful acts, the principal must compensate the agent for all lawful acts done within the authority. Even if the act unintentionally harms someone, the principal must indemnify uh, for the act of agent if the act is done in good faith. And if the agent commits fraud while acting within his authority, the principal is also liable for those frauds. The key point to remember here is that the agent is acting within his authority, whether for the benefit of principal or for himself. Now let's understand contract of bailment. A contract of bailment happens when one person delivers goods to another person for specific purpose under an agreement that once the purpose is completed, the goods will either be returned to the bailer, the person delivering the goods, or disposed of as per his instructions. So the person who is deliver the goods is known as the bailer, and the person to whom the goods are delivered for that specific purpose is known as bailee. And this contract of bailment is defined under section 148 of the Indian Contract Act. The key idea is that ownership of the goods stays with the bailer, but the possession shifts from bailer to bailee. So when you gives your cloth to a dry cleaner, uh, it is a contract of bailment. Or you leaving your car at the service station for repair, it is a contract of bailment. Or when you hand over goods or your gold jewelry to the bank as security, it is a contract of bailment. So in all these cases, you remain the owner, but the possession transforms from you to that particular dry cleaner or that service station guy or to the bank. So the possession transfers. Now let's understand about the features of bailment. So there's a delivery of goods. Bailment requires physical delivery of goods. So delivery can be actual or constructive. Actual meaning to say handing over the goods, or constructive meaning to say handing over the keys of a warehouse where the goods are stored. Bailment exists only when goods are delivered for specific purpose. For example, delivering ornaments to a goldsmith for repair, there should be a return of goods. So there should be a return of goods. So the bailee must return the same goods, not their equivalent. So if you deposit your gold chain in a bank locker, the exact chain must be returned and nothing equivalent. So bailment arises from a contract. So there is a contractual relationship. It is based only on a contractual relationship. If property is deposited by court order, it is not a bailment. It arises only from contract. And possession should not be considered equivalent to the ownership. The bailer remains the owner. And bailment, when you deposit your money in the bank account, it is not bailment. Keep that in mind. When you uses bank locker and you put something into your safe custody, then there is a contract of bailment. Or when you give your gold jewelry against the loan, when the charge created is pledge, then it is also bailment. So pledge is a special type of bailment, and we'll understand it in types of charges. But the contract, main contract here is of bailment. Duties of the bailer. Uh, there should be a disclosure of defects by the bailer. So a bailer must disclose the known defects in the goods. If goods are hired, then bailer is responsible even for unknown defects. For example, if a person lends a scooter with faulty brakes without informing, then the person is liable for the damages. Bailer's duty of care. So bailee must take care of the goods as much as a reasonable person would take care of his own. So if you leave your laptop with a friend and he keeps it safely, but it is stolen during a burglary, he is not liable. But if he leaves it unattended in a park, then he is liable. There is return of goods. So bailee must return goods once the agreed time is over or the purpose is completed. If there is a delay, then he will be liable. There should not be an unauthorized use. So if bailee uses goods beyond the agreed purpose, bailer can terminate the contract and claim the damages. And bailment is voidable if bailee himself violates the condition. So the contract of bailment becomes voidable. If there is a mixing of goods, so mixing of goods can be done with the consent of the bailer or without the consent of the bailer. So if it is with the consent, then the bailer and bailee shares uh, the joint ownership in the proportion to their shares. For example, a bailer has 100 kg of wheat, say particular A wheat, and B has say 50 kg of particular B wheat. So when they are mixed, so it becomes 150 kg. So A will be A will enjoy the ownership, two-third ownership, and B will enjoy one-third ownership of these goods. It can be done without consent, and there are particularly two cases. If it is also done without consent, then the goods can be separable or inseparable. So in this case, in this particular case of wheat, the wheat will not be able to separate, we will not be able to separate the wheat A from wheat B. So if it is inseparable, then the baler is entitled to compensation for loss. So baler must be compensated in this particular case. And if it is separable, for example, a particular white bead is mixed with a particular red bead, so it is separable, although it will take some expense to separate them. So, but the property is separable. So the bailee pays the expense for separation. If there is any increase in the profit, so if there is any increase in the bail goods, it must also be returned. So if Bailed cow gives birth to a calf, so both cow and calf must be returned. Rights of bailee, this a right of compensation, right to compensation. So if bailer was not entitled to bail goods and bailee suffers a loss, then bailer must compensate. There is a right to indemnity if bailee delivers goods back in good faith as per bailiff's instruction. He is not liable even if bailer has had no ownership. So if A gives B's watch to C, claiming it is that it is his own, and C returns it to A, then C is not liable to B. If bailment is gratuitous, so without any payment, bailer must reimburse bailee for necessary expenses. If you give your horse to a friend without payment, you must bear its feeding cost at least, right? So there is a right to recover expense. Now, Bailey's lien. So, if Bailey improves goods with his skill or labor, he can retain them until he is paid. So, if a tailor stitches clothes to make it a suit, so he can retain that suit until the payment has been made to him. And there are two forms of lien. There is a particular lien, and then there is a general lien. What I have just discussed is an example of a particular lien. And for general lien, then there are certain professionals like banker, policy brokers, factors who can retain goods for journal balance of accounts unless it is agreed otherwise. So bank can keep pledged jewelry not only for one loan but against all dues owned by the customer. So it is a journal lien. Now let's talk about type of charges. We start with assignment, then move on to lien set off. We'll understand what is a pledge, mortgage, and lastly we'll understand right of appropriation. So with respect to assignment, assignment is a way for a borrower to provide security to a bank by transferring a right, a property, or a debt to the bank. The borrower who transfers the right is known as the assigner, and the bank or the person receiving the right is known as the assignee. Now, what is the purpose in banking? Let's first understand it, then we'll move into technicalities. So, a borrower often assigns actionable claims such as book debts, government payments, LICs. So, book debt is money owned by a customer for goods sold or services rendered. There can be government payments, or there can be life insurance policies, which we have covered in our previous unit. So, the bank can claim this amount if the borrower defaults, right? So, borrower assigns them and borrows money from the bank, and if he defaults, the bank can claim these amounts from the say insurance policy provider or from the customer who owes something to the borrower in that particular manner. uh, Legal basis of assignment is that section 130 of the of property act states that the transfer must be in writing and it should be by the assigner or authorized agent, right? So, a transfer or actionable claim can only be through a written signed instrument. Actionable claim is defined under Section 3 of the Transfer Property Act. So, an actionable claim is a claim to any debt which is not secured by mortgage, pledge, hypothecation, or any beneficial interest in movable property, which is not in claimant's possession. Now, assignment can be done with or without consideration. There is no prior notice to the debtor. So, though no prior notice to the debtor is legally required, and the bank can sue the debtor directly in case there is a default, and the bank inherits both right and liability of the assigner. So, before understanding these case laws, let's understand types of assignment. So, there are three types of assignment per se: absolute, equitable, and legal. So, absolute assignment is full transfer of rights, which is legal in nature and requires written notice to the debtor. Equitable assignment is a transfer where formalities are not fully completed and there's less of its enforceability in the court of law, and legal assignments are fully compliant with writing and notification formalities, and they can be enforced in court of law. Now let's understand these case points. So in Dena Bank versus Bika Bhai uh, Pare case, it is held that the government debts have priority over other debts if statutory provisions exist. And its paper mill case, it was held that a machinery which is fixed to the earth may still be considered movable property for excise duty purposes. Installation does not automatically convert it into movable property. Lien, we have discussed lien in detail in our unit number 7. Lien in set off we discussed there. So what is lien? Lien gives the banker the right to retain possession of goods or securities until the customer paid its debt. So a lien, that's why is also known as an implied pledge, because it gives the banker the right to retain the possession. Section 171 of the Indian Contract Act states that a banker has a general lien on goods or securities which are received in ordinary course of business. So if a customer deposits valuables as part of banking business, the bank can hold them until the dues are cleared. For items which are left inevidently, which are not intended as security, so they cannot be held as lien. So if a borrower leaves a packet which contains shares, his life insurance policies in the bank, so bank cannot hold a lien over these uh, securities. A negative lien is a special type of lien where borrower undertakes not to create any charge on assets without the bank's permission, and it applies to assets which are not in possession of the bank, and no registration is required for these negative liens. Set off set off allows the bank to adjust a customer's debt with any amount the bank owes to the customer. So net result is the balance payable to the bank or to the customer. So it is a statutory right to adjust the mutual debts between the debtor and the customer and the creditor. So the creditor owes something to the bank. So creditor has fixed deposit, say, of 1 lakh rupees, and bank has given him a loan of 50,000 rupees. So a net amount of 50,000 rupees will be payable to the customer in this particular case. There are certain key features. So debt must be certain and existing. Future or contingent debts cannot be used set off. You cannot use set off against a guarantor until his liability is determined, and current account balances cannot offset contingent liabilities. Parties must be mutually indebted, and credit in partner's personal account can offset partnership account, which is a joint liability. Lien cannot be exercised at the same time as set off. Only one right is applicable at one particular time. Either you can use the right of lien or you can use a right of set off. Automatically set off. So meaning to say there is no need to provide a notice in this particular cases. So when there is a death, insanity or insolvency of the customer, insolvency of partner, or winding up of a company, receipt of a garnishee notice or notice of assignment of a credit balance is there. So in this particular cases, no notice is required to be provided. So status of availability of set off. So in particular cases, for example, if partnership, if there's a deposit in the name of partnership and a partner has taken a loan, then you cannot use this balance which is in partnership firm's account to set off. So, but if there's a vice versa, if the deposit is in the name of partner and the loan is taken in the name of partnership firm, then then the right of set off is available. For single person deposit name and loan is taken jointly, then there's availability of set off. But again, if the deposit is in joint account and the loan is taken by one of the joint holders, then you cannot set off the amount from this joint account loan. Single name, same name, loan in same name, status available, proprietorship again, they are not considered separate in the eyes of law. So status is available. First set of uh, for trust and trustee. In either case, the status is not available. In dividend account of a company and the loan is taken in the name of company, then again the status is not available. And if the deposit is in minus name and the loan is taken by guardian, then again this will the right of set off will not be available. Now let's understand hypothecation. Hypothecation is nothing but a charge which is created over movable property without transferring the ownership or physical possession. So there is no transfer of ownership or possession. Hypothecation is defined under SARFAESI Act. So in hypothecation, borrower retains the possession and the ownership, and bank has a legal right to claim or sell the goods if borrower defaults. It is primarily used for working capital loans. If I particularly quote section 2 definition, so it defines hypothecation as a charge in or upon any movable property which is existing or future, which is created by the borrower in favor of secured creditor without delivering of possession to the creditor as security for financial assistance. And it includes floating charge and their crystallization into fixed charges. So it includes present or future movable property. There is no delivery of possession. It includes floating charge and its crystallization. It differs from pledge and mortgage. So before that, just understand the key characteristics that it is for movable property only and not for immovable property, only for movable property. There is no transfer of ownership or possession. Then third is bank has a equitable charge. Bank has an equitable charge, and floating charge can convert into fixed charge upon specific event. So there is a crystallization, floating charge into fixed charge. Now, how it differs from pledge? Because in pledge, the possession also passes. The possession remains with the borrower and not the owner. And mortgage applies to immovable property and not movable property. If hypothecation, on the other hand, applies to movable property. Now, let's understand the aspects of related to hypothecation. So this particular facility is provided to respectable customers, number one, and it can be given to sole proprietors, partnership, joint companies, individuals. Bank generally provides this facility to trustworthy customers, especially companies, because Registration and Companies Act of its SERC makes charges legally enforceable and it reduces risk of multiple claims or disputes. So, in which situation hypothecation is used? So, hypothecation is particularly used when goods continuously change uh, or they are in use. For example, work in progress goods which are used in factories, or goods which are handled daily and in the processing units, goods which are sold daily and which requires constant turnover, say in showrooms, in retail shops. So for these particular goods, the facility of hypothecation is used. Again, there are certain drawbacks that the borrower retains the possession, so bank cannot directly control or monitor the goods. A borrower may sell high value goods and leave obsolete stock for the bank. A borrower may pledge or hypothecate the same goods to other bank, or selling goods in default is time consuming, costly, and legal complications are involved. Floating charges created within 12 months of winding up of the company becomes invalid under Companies Act. And if market value of goods drop, hypothecated stock may not cover the loan. So these drawbacks are always there. But what are the precautions that a bank can take? There's also one thing which we need to discuss before the precaution of the bank. So legal registration and protection. So companies must register hypothecation. They must register hypothecation with registrar of companies. And if there is a failure, uh, then failure makes it void against liquidator or other creditors. With respect to movable property, charges registered with CERC provides public notice and legal protection, and protects banks' right and prevent borrower from hypothecating same goods elsewhere. Right. Now let's move on to precautions taken by bank to reduce these drawbacks we have just discussed. The bank adopts several safeguards, like there should be single bank borrowing. It ensures that borrower is not using the same stock to secure loans elsewhere. Public notice is provided, so on display boards at storage locations, a notice is particularly placed declaring that the goods are hypothecated. We register the charge with registrar of companies or with CERC. We do stock verification on regular basis. So regular statements of stock with respect to quantity, quality, and values there. Periodic physical inspections are done. Periodic checks are done to ensure security margin is maintained. We track the borrower solvency, profitability, and market fluctuation, and we take steps if value of goods drops or borrower's financial condition worsens. A hypothecation is particularly governed by hypothecation deed. So we have hypothecation deed. So the hypothecation agreement is a legal contract that protects bank, and in hypothecation deed we generally include clauses like loan request, description of goods, that there should be no future income branches, inspection rights, insurance, that the borrower will insure the goods, uh, security will maintain a margin, borrower will pay for taxes, rents, or other expenses, that the bank can demand repayment of the loan anytime on default of the bank, the borrower acknowledges the debt, there is a continuous security, uh, that the hypothecation remain valid even if account shows temporary credit balance, and the borrower agrees to hand over goods if demanded by the bank. Now let's understand pledge. So a pledge is a legal arrangement where the borrower deliver goods to a lender as security for repayment of a debt or promise or performance of a promise. So the lender can retain and if necessary sell the goods to recover the debt in case of default. It is defined under section 172. So it is a special type of bailment. So section 172 defines the contract of pledge as bailment of goods for the purpose of providing security for payment of debt or for performance of a promise. The person who delivered the goods is known as pawner, and the person who received the goods is known as pawnee. Uh, what are the essentials of a pledge? So there's a contract regarding specific goods. So the goods must be specified it should be existing in nature. Pledge cannot be created for future goods. Keep that in mind. Hypothecation can, on the other hand, be created for the future goods. There is a delivery of possession. There can be actual delivery or constructive delivery. Bailment must be by authorized person. So the goods must be delivered by the pawner or someone who is authorized to act on their behalf. The delivery must be to secure the payment of a debt. So the purpose of delivery should be to secure the payment of debt or the performance of the promise. The pawnee gets special property rights. He gets the possession. So only special property passes to the pawnee while ownership remains with the pawner. Once the debt is repaid, the ownership and control they are fully revert to the pawner. Legal implications. So ownership retention is with the pawner. So the pawner retains the ownership and the possession is with the pawnee. So the actual or constructed delivery is essential. Without a transfer of possession, a valid pledge cannot be created. With respect to mode of delivery, there is physical delivery or there can be symbolic delivery. Atonement can be there. So with respect to physical delivery, we directly transfer the goods to the pawnee. With respect to symbolic delivery, the transfer of documents or keys are given, which gives the effective control to the pawnee. For example, goods are placed in a warehouse, and if you hand over the keys of the warehouse where the goods are stored, you are doing a symbolic delivery. There are atonements, so a third party like a warehouseman acknowledges holding goods for pawnee. It is known as atonement. So delivery can be actual, constructive, or symbolic. Agreement of pledge can be written or it can be implied. So pledge can arise from circumstances or conducts, meaning to say implied or inferred by circumstances, or it can be written. So written agreement clarifies the terms, rights, and remedies only for existing goods and not for future goods. And once the goods are lost, the pledge is lost. So when the possession is no longer with the pawnee, so he loses the pledge. Now, who can create a pledge? So, owner of the good can create a pledge. Mercantile agent can create a pledge if the possession of goods or documents is with him with the consent of the owner. He acts in the ordinary course of business, and pawnee acts in good faith without the knowledge that the agent lacks authority. In all these cases, mercantile agent can create a pledge. A person under voidable contract can create a pledge until unless the contract is not rescinded. So until not rescinded, the contract, a voidable contract, is a valid contract. So a person in possession under a voidable contract can also create a valid pledge, and seller who retains the possession may pledge goods even after sale if pawnee acts in good faith. Now pawnee can repledge goods to another lender, but only to the extent of his interest. Original pawner retains the primary rights to reclaim goods upon repayment of the debt to first pawnee. Even if goods are with the second pawnee, repayment to first pawnee restores the pawner's right. Now, what are the rights of pawnee? So, there's a right of retainership. So the pawnee can retain possession of the pledged goods not only until the original debt or obligation is repaid, but also for interest on debt or all proper and necessary expenses incurred for preserving the pledged goods. While ordinary expenses allows the pawnee to retain the goods, extraordinary expenses cannot create a lien. The pawnee cannot retain the pledged goods for debts or obligations unrelated to the original pledge. and the pawnee has same remedies as an owner against third party who interferes with the pledge goods. Now, in case there is a default by pawner, the pawnee has three options. He can sue the pawner, he can retain the goods, or he can sell the pledged goods. If he sues the pawner for repayment of debt or performance of the promise, he can do it. Now, he has a concurrent right to sue and retain the goods. So, he can right to retain uh, the goods, and then he can sue for the debt. So, it is a concurrent right. He can do this at the same time, right? And then there is an alternative right that he can either retain the goods or he can sell the goods. So, this is concurrent and this is alternative right. So, concurrent or alternate, but again he has to provide a reasonable notice. And after the sales, if the proceeds are greater than the debt, so the pawnee should return the surplus, and if the proceeds are less than the debt, then the pawnee still remains liable to pay for the balance. And pawnee can sue third party. The damages shared between pawnee and pawnee, and there's a limited interest of pledge, so it is valid only up to the extent of pawnee's interest. So, in event of loss or damage, while in possession, the pawnee steps into the shoes of owners for legal purpose. If goods are stolen or damaged, the pawnee can file a suit against the wrongdoer, and any damage which is recovered are shared between pawnee and the pawner according to their respective shares. Now, rights of pawner. So, the pawner is the person who delivers the goods as security for loan or obligation. Even though the pawnee holds the goods, the pawner still enjoys certain protection under the law. He has a right to receive a notice of sale. So, the pawner must receive reasonable notice before the pawnee sells pledged goods in case of default. He has a right of surplus proceeds. So, if the pawnee sells the pledged goods after giving reasonable notice, any amount exceeding the debt must be returned to the uh, pawner, and he has a right to redeem. So, the pawner can redeem the goods even after the stipulate repayment date, provided the pawnee has not yet sold the goods. Uh, with rights comes the duties of pawner. So, the pawner has certain duties to protect the pawnee's interest and ensure smooth handling of the place. So, the pawner must inform the pawnee about any material defect or extraordinary risk associated with the goods. He has to pay for any preservation expenses which are necessary expenses incurred by the pawnee to preserve the goods. If the pawnee sells the goods in a forced sale and the proceeds are less than the debt, the pawnee must pay the balance. The pawner must own the good at the time of pledge, and bank typically requires a written pledge agreement covering that all the goods and associated documents of title are deposited. There is a declaration that the pledge covers existing and future debts, interest, and expenses. The pledge acts as a continuing security without limitation. Pawner ensures goods are insured adequately and maintains agreed margin. There is a commitment to pay all amount secured by the pledge on demand, with the right of sale in case of default and the right of the bank to insure goods or hire brokers with the cost borne by the pawner. Pawner submits periodic stock statement and allows inspection by the bank. There is a declaration that the bank's journal lien right remains unaffected. With respect to advantage, there is a ease of sale. So, since the pawnee has the custody of goods, sale in case of default is straightforward. Close supervision can be done by the pawnee, which prevents the pawner from creating subsequent charges or manipulating the stock. Even if goods are lost or damaged, bank can recover under insurance, and pledge requires less documentation and legal formalities when we compare it with mortgage. What are the precautions in pledge? So, it ensures pawner has clear title to goods. We draft a complete pledge contract covering all the clauses. We maintain full cover over pledge goods. We display signboards at the godown stating that the goods are pledged. We exercise ordinary prudence in preserving goods to prevent loss of value. We conduct periodic inspections to verify quality, quantity, and valuation, and to ensure maintenance of reasonable margin throughout the loan period. Now let's understand the distinction between pledge and lien and pledge and hypothecation. So with respect to right to sale, pawnee has right to sale in case of pledge. There is no right to sale in lien, whereas pledge, in pledge the pawnee has right to sale. Pawnee acquires special property in the goods, so general ownership remains with the pawner. In lien, there is no transfer of interest. The lien holder only retains the possession. Pledge can still be enforced, can still enforce the debt through legal remedies. Lien disappears immediately if possession is lost. Pledge is assignable, whereas lien is not assignable. In hypothecation, the main difference is of possession. So possession is delivered in case of pledge, whereas it is not delivered in case of hypothecation. Pawnee can sell the pledge goods in case of pledge, and in case of hypothecation, lender must first take the possession before selling the goods. The applicability of pledge is with respect to movable assets, shares, or goods, whereas hypothecation is used in case of loan is where the loan is given against vehicle, loan is given against the stock or accounts receivables and inventories. Now let's understand about some of the important case laws. So first we have Movie Mercantile Bank versus Union of India. So here a company entrusted railways with boxes and endorsed the railway receipt to the bank. Railways failed to deliver the goods. Bank filed a suit for recovery of the value of goods. So it was held that the bank can recover the value of goods because the pledge can be created by endorsement of the railway receipt because it is a constructed delivery and constructed delivery is sufficient. Actual delivery is not mandatory. Bank as pawnee had right of the owner under the pledge. Lalan Prasad case. So in Lalan Prasad versus Rehmat Ali, a loan was provided with a pledge of uh, some arrows scraps. The pawnee lost the possession of goods. So the decision of this case was that the pawnee can sue for debt recovery only if he is able to return the goods to the pawner when the debt is repaid. So pawnee's right to file a suit is conditional on ability to return the goods upon redemption. Then we have Bank of Bihar versus State of Bihar case. So here the bank lent money which is secured by sugar pledge. Government seized the sugar and sold it to recover the government dues. Now, the decision of this case is that the government cannot override the pawnee's right and the bank is entitled to recover the money from the government. So the pawnee's right are legally protected even against third party claims. And then we have Standard Charter Bank case. So here it was held that the pawnee is entitled to accreditations as part of security. Upon default, pawnee can sell pledge property including accreditation. So if there is any increase in value during the pledge period, it belongs uh, to the pawnee. But again, pawnee can use it as part of the security. Now let's move forward to mortgage. So mortgage is a way of using immovable property as security for a loan. So mortgages are a type of charge which are applicable on immovable property and it has been defined under Transfer of Property Act. Uh, Section 80, Section 58 to 99 and Section 102 to 104 are the relevant sections for us. So it is defined under TPA of 1882. So, when a borrower gives a mortgage, they transfer an interest in the property. So, keep that in mind. In a mortgage, there is a transfer of interest. to the lender. So the person who is transferring the interest is known as mortgager, and the person to whom the interest is being transferred is known as the mortgagee. And this transfer of interest is particularly to secure repayment of money lent or to be lent. So the mortgager transfer interest. The purpose is to secure the money, uh, and this money could be which have been already been borrowed or money to be borrowed in the future, and the liability arises from non-performance of some obligation. So bank deals with immovable property, securities created when there is transfer of interest, and it does not apply to movable property. For movable property, we have pledge, we have hypothecation. Uh, so this is sale. In sale, there is a transfer of ownership, right? In sale, there is a transfer of ownership. In mortgage, there is transfer of interest, and if the value exceeds 100 rupees, so the sale must be done via registered document. The lift property happens when the seller gives the buyer possession or someone the buyer directs. So this is different from mortgage, which is not transferring full ownership, but only creating an interest in the property. Definition of mortgage is provided under section 58A. So section 58A states that a mortgage is a transfer of interest in specific immovable property to secure repayment of money advance to be advanced or arising out of particular pecuniary liability. Essential elements is that there is a transfer of interest. A mortgager must transfer some interest in the property, and the purpose is to secure the loan. Mortgage is the person who transfers this interest. Mortgage is the person in whose favor this uh, interest is being transferred. Mortgage money refers to the money which has been lent by the bank, this mortgagee. It includes principal and interest amount, and mortgage deed is the instrument which is used to transfer. So we just like we have a hypothecation deed, pledge deed. Uh, so we also have a mortgage deed. So eligibility to mortgage, who can transfer this interest, who can be a mortgager. So any person who's competent to contract is eligible to transfer the property, and he can be an absolute owner, a co-owner, a karta of HUF, a guardian, or the executor or administrator. So executor or administrator can also mortgage property belonging to the deceased person. Now let's understand about the types of mortgages. So there are particularly 6 types of mortgages, starting with simple mortgage. A simple mortgage is when a person borrows money and promises to repay it but does not hand over the property to the lender. If the borrower fails to repay, the bank can go to the court and get the property sold to recover the money. So the borrower keeps the possession of the property, and the borrower personally promises to repay the money. If the borrower defaults, the lender can approach the court to sell the property. The key features are that the lender cannot sell the property directly. uh, there's no right to the mortgagee to sell without the court intervention. So court intervention is required. If the property does not cover the full debt, the borrower remains personally liable for the balance. The lender cannot claim rent or produce from the property, and the lender does not take the possession of the property. A registration is required if the loan amount is more than rupees 100. Mortgage by conditional sale. So here the borrower pretends to sell the property. There is an sale ostensible sale is there. So the borrower pretends to sell the property to the lender on the condition that if the loan is not repaid on time, the sale becomes final, and if the loan is repaid, the property returns to the borrower. So to create an mortgage by conditional sale, the property is ostensibly sold, but it is not a real sale. If the repayment is not made, the lender can get a court decree to make the sale absolute, and the borrower loses the right to redeem the property. The sale becomes absolute. There is no personal promise to repay, and the lender cannot claim other assets if the property sales is insufficient. The bank does not prefer mortgage by conditional sale because there is no personal liability of the borrower. Recovery depends on court intervention, and there is no recourse to other assets if sale proceeds are insufficient. Usufructory mortgage. In usufructory mortgage, the borrower gives possession of the property to the lender. The lender can use the property and receive rent or profit to pay off the interest on loan. The lender is legally in possession and the lender can collect rent or profit instead of charging interest. So if there's no repayment, personal repayment promise exists, the lender cannot sue for money, and no specific repayment time is there, so the lender can keep possession until the debt is repaid. And if the borrower does not redeem in 30 years, the lender becomes the absolute owner. Again, this is not preferred by bank because recovery may take a very long time, and again there is no personal guarantee to repay. English mortgage. An English mortgage is where the borrower transfers the property absolutely to the lender, but promises to repay the loan by a certain date. Once repaid, the lender transfers the property back. So there is an absolute transfer to the property to the lender. There is a personal promise to repay by a specific date. Conditions are there that the property will be retransferred once repayment is done, and the lender can sue and sell the property if repayment fails. And this is the most common type of mortgage uh, which banks are involved in. So mortgage by deposit of title deeds and equitable mortgage. So equitable mortgage is not defined under the Transfer of Property Act. It is mortgage by deposit of title deeds. Um, so deposit Mortgage by deposit of title deed is a way of giving a loan against property without creating a formal mortgage deed. So instead of registering a legal mortgage, the borrower gives the original document of ownership of the property to the bank as security, and according to Section 58F of the Transfer of Property Act, this is allowed in certain towns or other towns which are notified by the state government. The property itself may be anywhere, only the place where the deeds are deposited, it matters. And what are the document of title? So, document of title are papers that prove the borrower legally owns the property and has a right to use and enjoy it. A sale deed, conveyance deed, any legal instrument showing the ownership is a documents of title. And in Syndicate Bank versus Modern Title City Works, the court clarified that title deeds are legal papers proving a person's right over a property. With respect to key features, to create a mortgage by deposit of title deeds, some of the conditions are to be fulfilled, like delivery of title deeds. So the borrower must give deed to the bank and its authorized agent. There must be an intention to create the security. The location restriction are there, so the deed must be delivered in a notified town. The property can be anywhere, but the deed must be delivered in a notified town. There are three ingredients uh, that a debt exists. There should be a deposit of title deeds and the intention that the deeds are for the purpose of securing the debt. There is no need for a written mortgage deed. So, unlike other mortgages, an equitable mortgage or a mortgage by deposit of title deeds does not require a mortgage deed signed and witnessed. It does not require registration, and other type of mortgages must be in writing and registered, apart from mortgage by deposit of title deeds. Now, there is a certain procedure to create this particular type of mortgage. The usual steps involve the title clearance certificate, which is obtained from a lawyer confirming that the property is free from legal disputes and it can be sold. Land records are searched and ownership is checked. So, you have to check as a bank records for last 30 years to ensure no income branches exist. Then the original title deeds are delivered personally by the borrower or authorized agent in the notified town. Bank prepares a memorandum of entry. It records the equitable mortgage. Paid the memorandum as per state laws. Stamp duty is paid, and registration is not required. And if a company is borrowing, it must pass a board resolution authorizing an officer to deposit the deeds. After the memorandum is recorded, the charge is filed with the registrar of companies. Uh, with respect to merits, it saves registration charges. It is quick, simple, minimum formalities are required, and it is confidential. It does not attract public attention, protecting the borrower's privacy. With respect to demerits, court intervention again is required in case of default. So, if the borrower default, the bank must go to the court to sell the property, which is time consuming. Uh, there are trust property issues. So if the borrower holds the deed as a trustee, the beneficiary claims uh, prevail over the bank's mortgage. So, bank must carefully verify the title before accepting the deed, and always a risk of subsequent mortgage is there. So the borrower might create another legal mortgage with a different lender. In India, a deposit of original title deed ensures priority, so the equitable mortgage prevails over any later mortgage. In England, however, subsequent legal mortgage can override an earlier equitable mortgage, but this is not the case with in India. Anomalous mortgage, it has not been defined. It is simply a special type of mortgage, which can be created by mixing different type of mortgages. So any mortgage which does not fall under the category of simple mortgage, mortgage by conditional sale, usufructuary mortgage, English mortgage, or mortgage or by deposit of title deeds is an anomalous mortgage. It is essentially a catch-all category of mortgages that does not fit neatly into other types. It must be a mortgage according to Section 58 of the Transfer of Property Act. It has been negatively defined. This means it is not defined by what is not, that is, it should not be any of the standard type of mortgage listed above. It is a combination of different mortgages, often as like combination of a simple mortgage, usufructuary mortgage, and mortgage by conditional sale. Uh, in some regions, local practices may create other forms of anomalous mortgage. Think of it like a hybrid mortgage, tailored to specific needs, often created by customs or agreement between the parties. Now, let's understand priority of mortgages. So, the law decides whose mortgage take precedence if multiple mortgages are created over the same property. As a general rule, Section 48 of the Transfer of Property Act states that there is a priority. Priority is based in time. So, first in time is the first in right. Any later created mortgages are subject to earlier ones, but special cases exist. So, Section 47 of the Registration Act 1908 specifies that even if a mortgage is registered later and if it is executed earlier, then the execution date decides a priority. For example, mortgage A was executed on January 1st, 2025, but was registered on on February 1st, 2025, and mortgage B was executed on say January 10th, 2025, but it was registered on January 20th, 2025. So according to date of registration, mortgage B should prevail, but this is not the case because mortgage A was executed earlier, although it was registered later. So mortgage A has priority based on execution date. Priority between registered and unregistered instruments. So normally, registered instruments have priority over unregistered ones, but there are certain exceptions. Prior mortgage by deposit of title deeds is not affected by later registered mortgages, as this type of mortgage does not need registration. Some rules are also borrowed from ancient Hindu law and English law principles like delivery of possession impacting priority. With respect to limitation for filing a suit to recover mortgage debt for sale of mortgage property, the limitation period is 12 years, and for foreclosure of mortgage property, the limitation period is 30 years. And now, what does this term foreclosure means? Foreclosure means that the bank can take ownership of the property to recover its dues. So, for foreclosure, it is 30 years, and if the borrower fails to repay, the bank can file a suit to sell the mortgage property within 12 years. What is the difference between a mortgage and a pledge? Pledge is created with respect to a movable property. Mortgage is with respect to immovable property. Number one, the borrower keeps the ownership. Lender only keeps a limited right. In mortgage, legal ownership passes to the lender, but the borrower has the right to redeem it later. Foreclosure is not allowed in pledge and it is allowed in mortgages in certain cases though, but it is allowed on the type of mortgage and court decrees. Enforcement of mortgage. So, with respect to type of mortgage which are preferred by bankers, so mortgage by deposit of title deeds, simple mortgage, and equitable mortgage is the most common practice, but these two types of mortgages are preferred by the bankers. With respect to enforcement of mortgages, so bank can recover mainly by two ways: by sale without court intervention and enforcement through court. So these are the two methods by which banks can recover their dues. So under section 69 of the Transfer of Property Act, the lender can sell the mortgage property without going to the court in specific cases. So if it's an English mortgage and neither party belongs to specified region or a class, if the mortgage deed gives explicit power to the bank to sell the property, and the mortgage, if the property mortgage is in major cities which are notified by the government. But there are some conditions before exercising this uh, sale. So the borrower must give a written notice, the default must continue for 3 months, and interest of at least 500 must be unpaid for 3 months. So these two conditions are to be fulfilled before selling the property. And with respect to distribution of sale proceeds, you have to first pay all the cost and expenses related to the sale, repay the mortgage amount and other dues, and thirdly, if there remains any balance, it goes to the property owner. And there is legal protection to the purchaser, that the purchaser title cannot be challenged for irregularities, and remedy for irregularity lies only in damages against the mortgagee, and nothing else. And SARFAESI Act, so bank can also use SARFAESI Act for loan above 1 lakh to take possession and sell the mortgage property without court intervention. And magistrates can help in forcible possession if it is required. With respect to enforcement through court, so when court intervention is needed, banks file a civil suit to recover dues. This is common for loans below 20 lakh rupees, or when section 69 conditions are not met. For loans above 20 lakh rupees, DRT, the help of DRT can be taken. Uh, some of the key points are that you have to file suit in the court with jurisdiction over the mortgage property. You include all the subsequent mortgages. Uh, you have to include all the subsequent mortgagees in the as defendants for multiple debts. Sue on all debts together unless the court permits separate suits. You have to ensure claims are within the limitation period. If personal covenants is to be enforced, court gives a two-stage decree, a preliminary decree and a final decree. Preliminary decree. So this particular decree gives time to the borrower to repay, and in final decree, if borrower fails, bank can proceed to sell the property with the help of court existence. So for 20 lakh or more, you can use uh, debt recovery tribunals, and for 20 lakhs and less, civil suits are to be filed. We have discussed these pointers, okay? So don't worry, we have discussed it. Lease of immovable property. So what is a lease? A lease is an arrangement where the owner of the property allows someone else to use and enjoy the property for a certain period or even indefinitely. In return, the lessee, so the person who's transferring the property, who's transferring this right to enjoy. So see, sale is a transfer of ownership, mortgage is a transfer of interest, and lease is a transfer of right. Okay. So the person who transfers this right is known as lessor, and the person to whom this right has been transferred is known as lessee. So lessee is the person who is actually enjoying the property. In exchange, he gives a rent or a premium. So it should not be confused with sale, because sale is an absolute ownership. A lease is only a transfer of possession or enjoyment. The ownership remains with the lessor. Duration of lease for agriculture or manufacturing lease purposes. If there is no written lease or no local usage rules, so for agriculture or manufacturing purpose, lease is assumed for from year to year, and either party can end it by giving a notice of 6 months. For any other purpose, the lease is assumed from month to month, and it can be terminated by giving a notice period of 15 days. Now, Chapsi Bhai, Ganjiji Bhai Danand versus Purushottam is an important case to understand. In this particular case, a lease was allowed on in somewhat 1906. So, in 1906, a lease was allowed. on a land for 30 years at an annual rent. It states that the after the lease period, the lessee could keep using the land, pay rent annually, and even transfer rights to his heir. The dispute here is the lessor built a nearby industrial structure and the lessee claimed it was a permanent lease. Now, the court decided that the lease was for lessee's lifetime and not permanent or fully inheritable. Just because the lease allowed heirs to succeed does not automatically make it permanent. A court should examine the substance of the lease and its term to decide whether it is permanent, lifetime only, or it is limited. Accessions is considered part of lease during its term. If added unlawfully, it must be returned after the lease ends. So, how leases are made? Leases for year or more must be created through a registered instrument. If it is for short-term leases, it can be done orally with delivery of possession or by a registered lease. If a leasehold property is mortgaged as security for loan, the original lease agreement serves as a title document. Lease agreement must be stamped and registered. Unexpired lease period must cover the bank's repayment schedule. And sometimes a tripartite agreement is made between the banks. So, lessor and the lessee should be the part of that tripartite agreement. Lease deed should include a clause allowing the lessee to mortgage the property, or the lessor must give a no objection certificate authorizing for this mortgage. Right of appropriation. So, the right of appropriation comes in play when a debtor has multiple debts with a creditor, and it is about deciding which debt a payment made by a debtor will be applied to. In banks, this often happens when a customer has more than one loan account, and the rules are covered under section 59, 60 and 61 of the Indian Contract Act. Now, the key idea is that debtor can specify which debt a payment should go towards, but the creditor has the choice to accept or reject this request. You should not confuse appropriation with set off, because in a right of appropriation, payment is applied before the debt matures. For example, if a fixed deposit is used to pay a specific debt before its maturity, it's appropriation. But in right of set off, the payment is applied after the debt matures. For example, using the matured FD amount to clear a loan balance. So, the timing here matters. So, if it is before maturity, it is appropriation, and if it is after maturity, it is set off. Uh, Now, let's understand what a charge is. A charge is essentially a type of security a company creates to borrow money or secure a debt. When a company takes a loan or issue debentures, it often pledges some of its asset or rights as a security, and this pledge is called the charge. Under Section 77 of the Companies Act 2013, the word charge includes a wide variety of assets and situations such as charge on debentures, charge on unpaid capital, charge on immutable property, on book debt, immovable property, floating charge, charge on unpaid calls, charge on ships or shares in ships, or charge on intellectual property. So, intellectual property is goodwill, patent, license, trademark. Um, its simple terms, a charge is any asset or right of a company pledges to secure a loan or obligation. There is a duty to register a charge according to Section 77, subsection 1 of the Companies Act. Any company creating a charge on its property or asset, whether in India or abroad, tangible or intangible, fixed or floating, does not matter. They must register the charge with the Registrar of Companies, and the registration must include the details of the charge and the instrument creating it, which should be signed by both the company and the charge holder. This ensures that the charge becomes public knowledge, protecting the interest of all parties and avoiding disputes over who has the right over the asset. With respect to registration of immovable properties, the mortgage or lease deed must also be registered with under the Registration Act, except in case of equitable mortgage. And registration under SARFAESI, under SARFAESI and SARFAESI. So, under Section 23 of the SARFAESI Act, banks and financial institutions can file details of charges with SARFAESI. Registration with SARFAESI is not legally mandatory, but banks usually require it. Once a security interest is filed with SARFAESI, it counts as a personal notice from the date of filing, and it gets priority over any later security interest created to the same property. Types of securities interest commonly registered with SERSI includes mortgage by deposit of title deeds, mortgage of any other immobile property, hypothecation of machinery, stock, receivables, or book debts, intangible assets like patent, copyright, trademark, know-how, licenses, franchisee right, and under construction property rights. So, under construction property rights are also secured by agreements other than mortgages. There are three charges which are does not require registration. They are guarantees, charges arising by operation of law, and hundi. Hundi is a traditional negotiable instrument used in India. Type of charges. So we can classify charges into two categories: fixed and floating. A fixed charge is a specific charge. It is attached to a specific property or asset of the company. So the bank or lender can sell that specific asset if the company defaults, and the charge is clearly defined on the asset. It gives the lender a strong right to recover the dues from that specific property. A floating charge, on the other hand, is journal and not attached to any other specific asset. It floats over the company's overall assets, and the company can deal with these assets in ordinary course of business until something triggers the charge. A floating charge uh, converts into a fixed charge if the company stops business or goes into liquidation, or the creditor intervenes. Uh, for example, they appoint the receiver, or any event mentioned in the charge deed, it occurs. And once crystallized, the charge becomes attached to the company's asset at that point, and it has priority over unsecured creditors and some other claims in liquidation. It is treated like a fixed charge over the assets at that moment. For registration, the time limit is 30 days. The ROC can extend it by another 30 days, and in exceptional cases, the registration may still be allowed for further 60 days. So procedures include using of certain forms like Form CHG1. It is for charges other than debentures. CHG9 is for debentures, and CHG5 is used to intimate certification of the charge, that is when the loan is repaid. A copy of the charge documents must be filed with the ROC, verified and certified. Now let's talk about consequences of non-registration. So non-registration does not make the charge invalid itself. However, in case the company goes into liquidation, unregistered charges are not valid against liquidator or other creditors. Court have clarified that unregistered charges can still be enforced by the bank against the company as long as the company is operation and not in liquidation. Now let's check your progress. The usual form of contract of agency is by way of power of attorney. So A is the correct answer. The pawnee can sell the goods if the pawner fails to pay. So this statement is true. The bailee can keep the goods bailed to him and he need not return the same to the bailer. This is actually false. So A is the correct answer. Under the Companies Act, a charge includes a mortgage, a promissory note, a bill of exchange, letter of credit. A charge includes a mortgage. So A is the correct answer. Hypothecation is an implied pledge in cases where delivery of goods is given, constructive possession of obligation is given. Constructive possession is right, but it should be of good. So constructive possession of good is given. So C is the correct answer for this question. Simple mortgage is created. It is created by an instrument in writing. So D is the correct answer for this question. Now let's move on to practice questions. We'll use elimination method to solve these questions because statements are generally more in these types of questions. So a contract must be supported by lawful consideration. So this statement is correct. So hence option A is eliminated. Every agreement is enforceable by law. This is not true. So option 2 is not correct. So B gets eliminated. So 3 and 4 are common in both C and D. So we are not required to read them. Let's move on to statement number 5. An agreement made without free consent also amounts to a valid contract. It can be voidable or void and not valid. So 5 is not correct. So D is eliminated. Hence C is the correct answer for this question. Which of the following statements regarding essentials of a valid contract are correct? Let's read statement number 1. A bid at an auction is considered a proposal and a promise as soon as the auctioneer accepted. So a bid is a proposal, and when accepted by the auctioneer, uh, it is a promise, and hence this statement is correct. So option B gets eliminated. Let's read statement number 2. A written and registered promise made out of natural love and affection between near relatives is a valid contract even if there is no consideration. So this statement is correct. So statement 2 is correct, and hence option C gets eliminated. Now let's read statement number 3. An agreement to sell immovable property is enforceable only if it is oral. No, it should be written, right? It should not be oral, and hence this is not correct. So all statements are not correct, leaving option A as the correct answer for this question. Which of the following statements are true regarding contract of agency under Indian Contract Act 1872? The principal must provide written consent for the agency to be valid. So this is not correct because written consent is not required to create an agency, and hence option A and B gets eliminated because this is incorrect. Sorry, option C and D gets eliminated, not A and B. This is asking for true statements. So one is not correct, and option C and D gets eliminated. Let's we can skip reading statement 2 because it is common in both A and B. Now let's read statement number 3. An agent can exceed their authority and still have the principal automatically rectify their action. No, principal does not automatically rectify. They can rectify, but it's not an automatic rectification. Hence, this is not correct. So A is not correct, leaving us with option B as the correct answer. Which of the following statements are true regarding duties and responsibilities of agent? An agent is required to follow the directions of the principal while conducting the business of agency. So this is absolutely true. So one is correct. So naturally option B gets eliminated. If an agent acts beyond the authority granted by the principal is bound by the agent's action. So if the agent acts beyond the authority which is granted, and then the principal is not bound by their action. So this statement is not correct. So all statements are true. This option gets eliminated. Let's read statement number 3 and we'll get our answer. The agent is liable to indemnify the principal for any loss incurred due to misconduct or negligence on the agent part. So agent is uh, liable for the misconduct. So this is actually correct. Agent is liable to indemnify the principal for any loss incurred due to misconduct or negligence on the agent's part. So this statement is correct. So 3 is correct. Uh, let's read statement number 4 as well. An agent is entitled to remuneration only when they have completed. So this statement, they are entitled to remuneration only when they have completed their task as per the agreement. Uh, so yes, remuneration is due upon completing the task. So this is also correct. Let's read statement 5. If an agent sells goods on credit without the principal's consent, the principal is not liable for the loss to the buyer. So, if an agent sells on credit without consent, the principal may still be liable to the loss. Uh, so, this statement is not correct. A del credit agent guarantees the buyer will fulfill their obligation. So, this is correct and may be liable. An agent can retain the principal's goods and property until the payment for service, commission, and disbursement is made. So, statement number 7 is also correct. An agent has a lien on the principal's property. So, this is correct. So, 1, 3, 4, 6, 7 are correct. So, 3 should also be there in option A, and hence option A will be correct. Let's read statements from question number 5. Which of the following statements regarding the contract of bailment are correct? So, we are not required to read statement 1. See, statement 1 is there in every option. Let's read statement number 2. If statement number 2 is correct, then option D gets eliminated. If it is not correct, we directly get our answer. But for clarity purpose, we also read other statements. Don't worry. The bailee is only responsible for the goods if they are damaged during transport. So bailee is responsible for goods not just during transport but also in other cases. So this statement is actually not correct. So naturally D will be the correct answer for this question. But since in the last question there was some confusions or some typographical error in the options, let's read other statement as well. So a bailer is responsible for disclosing any fault in the goods that could interfere with their use or expose the bailee to extraordinary risk. This is correct. Let's read statement number 5 now. The bailee, let's read 4 as well. A contract of bailment can exist without any specific agreement or condition between bailier and bailee. So no, for contract of bailment, it requires specific terms and conditions. So this statement is not correct. So again, 4 is not correct. Let's read statement number 6 now. If the bailee mixes the bailier's goods with own goods without consent, he is not required to bear the cost. He is required to bear the cost. 6 is not correct. So D is the correct answer for this question. Under which of the following statements regarding the assignment of actionable claim is or are not correct? Keep that in mind. The question is asking for incorrect statements. Under Section 130 of the Transfer of Property Act, the transfer of an actionable claim can only be effectuated by an instrument in writing signed by the transferor or their duly authorized agent, and the transferor must give prior written notice to debtor for the assignment to be valid. So this prior written notice is not required. So this statement is actually incorrect. So option A gets eliminated because we are asked about the incorrect statement. So one is incorrect. So let's read statement number 3 now. If statement number 3 is correct, then these two options gets eliminated, and if it is incorrect, these two options will uh, remain in question. So, in case of equitable assignment, the failure to notify the debtor results in the assignment being considered void and the transferee losing the right to enforce the claim in their own name. So, in equitable assignment, the failure to notify the debtor does not make an assignment void. Alright, so this statement is actually not correct. So, these two are in question. Now, let's read statement number 2. Because 3 is not there, so hence this statement option gets it gets rejected, it is eliminated. So the transferee of an actionable claim is entitled to exercise all the rights, remedies, and defenses available to the original transferor at the time of the transfer, subject to any encumbrances that exist at the time of transfer, irrespective of whether the transferee had notice of such encumbrances. So this is actually correct. We are asked about incorrect statements. So D gets eliminated. Only option C remains. So C is the correct answer for this question. Read the following statements regarding lien and set off. A banker's lien is a right to retain possession of goods and securities owned by the debtor until the debt is repaid. So this is correct. This gets eliminated. A negative lien is a right to sell goods and securities in case of non-payment of debt. So this is not correct. A negative lien is a undertaking not to create a charge, and it is not a right to sell the goods. So statement number 2 is not correct. So A gets eliminated. Now let's read statement number 4. A banker can set off a debt due on a loan account repayable on demand against a credit balance in the current account. So a bank cannot set off a loan account repayable on demand against the current account credit balance until the demand date is there or due demand arrives. So, so before that they cannot do it, and hence option D is the correct answer for this question. Consider the following statements related to hypothecation. Hypothecation is defined under Section 2 of the SARFAESI Act as a charge on movable property created by the borrower in favor of a secured creditor without possession. This is correct. So C and D gets eliminated. In hypothecation, goods are transferred to the creditor's possession to secure the loan. Possession is not given in case of hypothecation. Hence, B gets eliminated and A is the correct answer for this question. Which of the following statements are true about the concept of pledge under section 172? A pledge is a contract involving the delivery of goods as security for payment of debt or performance of a promise. So, this is correct. So, B, C, and D remains in the race. A gets eliminated. The person who takes the goods as security in a pledge is known as pawner. So, no, it is known as pawnee and not the pawner. So, D gets eliminated. B and C remains. So, 3 is common in both. Let's read statement number 4. The delivery of goods in a pledge must always be physical and simultaneous. So, it should not always be physical. It can be symbolic or constructive. So, statement 4 is not correct, and hence option C is the correct answer for this question. Which of the following statements are true regarding the rights of a pawnee under Indian Contract Act? The pawnee has a right to retain the pledged goods not only for non-repayment but also for interest and expenses incurred for preserving the goods. This statement is correct. So, C gets eliminated. 4 is common in all the statements. 2 is there only in option A and 3 is there only in option B. So, let's read statement number 2. A pawnee can claim a lien over the pledged goods for any extraordinary expenses incurred for their preservation. So, the pawnee cannot claim a lien for extraordinary expenses, but they can sue for extraordinary expenses. All right. So, they cannot uh, take a lien for extraordinary expenses, only for the necessary expenses which are there for the preservation. So, this is not correct. A pawnee can retain the pledged goods for any other debt or promise, even if it is not related to the original debt for which the goods were pledged. Again, this is not correct. Pawnee has the same remedies as the owner if the third party wrongfully deprives him. So, this is correct. So, statement 4 is correct. 2 is not correct. 3 is not correct. So, only option D remains. Let's read other statements as well. In case of a default by the pawnee, the pawnee may either retain the goods, sue the pawnee, or sell the goods after providing reasonable notice. This is correct. Pawnee's right to retain the goods and right to are concurrent. They are not concurrent, they are alternative. So, option D is the correct answer for this question. Which of the following statements are true regarding the concept of pledge, lien, and hypothecation? In pledge, the borrower transfers possession of the asset to the lender as security of loan. This is correct. So, option A gets eliminated. Lien allows the creditor to sell the assets if borrower defaults on the loan. No, lien only is a right of possession, and the borrower you cannot sell the assets of the borrower. So, this is not correct. So, statement 2 is not correct. So, A and C gets eliminated. A was already eliminated, so C also gets eliminated. 3 is there in both B and D, so we don't need to read them. Let's read option number 4. A lien is assignable to another party while the pledge cannot be assigned. So this is false. A lien is not assignable whereas pledge can be assigned. So B is the correct answer for this question. Consider the following statements regarding Transfer of Property Act 1882. A mortgage is defined as a transfer of interest in specific immovable property to secure the payment of money advanced or to be advanced. So, this is correct. Sale of tangible immovable property for consideration exceeding 100 rupees can be made only via registered instruments. This is also correct. So, C gets eliminated because it does not contain option number 2, statement number 2. The mortgager is the transferee of the property who receives the loan. So, the mortgager is a transferor and not the transferee, right? So, the statement is not correct. B gets eliminated. A guardian of minor's property can create a mortgage without the sanction of loan. No, sanction of loan is required if you are creating a mortgage over minor's property. So, this is not correct. So, only option D is remains, and it is the correct answer for this question. Which of the following statement about simple mortgage and mortgage by deposit of title deeds are correct? Simple mortgage involves delivery of possession. No, simple mortgage does not involve delivery of possession. It is usufructive mortgage. So A and C gets eliminated. 2 is common in both, so we are not required to read. 5 is unique. So let's read option number 5. In a mortgage by deposit of title deeds, the mortgagor delivers the title deeds to the mortgagee with the intent to create a security on the property. So this is correct. So statement 5 is correct. Let's read statement 6 as well. A mortgage by deposit of title deeds is applicable only in specific cities uh, like Kolkata, Chennai, Mumbai. So yes, it is applied only in specified cities or in notified cities. So 6 is also correct. So B is the correct answer for this question. Now let's move on to question number 14. Consider the following statement regarding the right of appropriation. The debtor has the right to specify which date a payment should be appropriated. So this is correct. If the creditor accepts the debtor's payment with a specific instruction, the creditor cannot divert the fund. This is also correct. So only 1 and 3 is not correct. Only 2 and 3 is not correct. So the right of set off is applicable only before the maturity of fixed deposit. It is after the maturity, before it is appropriation. So 3 is not correct. So option A is the correct answer for this question. Consider the following statements regarding registration of charges under the Companies Act. All charges created by a company, whether in India or abroad, must be registered with ROC, Registrar of Charges. So this is correct. C gets eliminated. Now let's read statement number 2. Registration of security interest with search is optional but treated as public notice once it is filed. This is also correct. So B gets eliminated. Now let's read statement number 5. Okay. So 1 is correct, 2 is correct. Now let's read statement number 3. So 2 is correct and hence B is eliminated. 1 was correct and hence C was eliminated. So statement number 3, equitable mortgages must be registered with a registrar of assurances. So equitable mortgage are exempted from registration and hence 3 is not correct. So A is the correct answer for this question. I hope everything is clear to you. But again, if you have any doubts, you can reach out to us on our Telegram group channel, JAIIB CIB Prep. Thank you for watching this session, and we'll meet again soon with unit number 27.